Tata Motors has managed to deliver a steady set of numbers, in fact an impressive performance for the quarter gone by. If you look at the bottom line performance as well as the margins front, the operational performance of the company for Q3 of FY21, they have managed to surpass the ET Now and Street expectations. Revenue, well, largely in line. Let me take you through the consolidated performance first. Revenue came in at 75,653.8 crores, up 5.5% year-on-year. Profits were up a solid 67.5% compared to the same period last year, coming in at 2,941.5 crores. As far as EBITDA is concerned, they reported an EBITDA of 11,000 crore, which implies that the calculated margins or rather the reported margins stood at 14.8% for the company for the quarter gone by. So clearly you can see a stellar beat on the margins performance, because we were expecting it to come in at 12.9%. What they handed in was 14.8%. As far as JLR's performance goes, they've achieved an EBIT margin of 6.7% and also reported a strong positive free cash flows of about 0.6 billion pounds, reflecting recovery in sales, favourable mix and charge plus delivery, which continues to be on track and continues to yield good results for the company. On the back of charge plus, they delivered about 0.4 billion pounds worth of savings in the quarter, and YTD, which is year to date, the savings are at 2.2 billion pounds. PBT came in at 439 million pounds. It was up 374 million pounds on prior quarter and 121 million pounds year on year. EBITDA margins came in at a strong 15.8%. They saw a 560 basis points expansion year on year as far as EBITDA margins of JLR are concerned. It's not only the consolidated figure saw a healthy expansion, but of course even JLR on its own also delivered a very steady set, showing the fact that it contributes so extensively to the overall performance of the company. Retails for JLR were up 13% QOQ at 128.5 thousand units, down 9% year on year. Despite prevailing external risks, they expect to deliver strong EBIT margins and positive free cash flow even going forward in Q4. Favourable sales mix, cost performance, partial reversal of prior period reserves for emission and residual values were the key triggers and the key aiding factors this time around. They expect to generate strong EBIT margins and positive free cash flow going forward. They are encouraged by Brexit deal that was concluded in December. All plants are open for JLR. Majority of retailers in most regions also continue to be functional. As far as the consolidated business, or specifically the India performance goes, it continues to be strong. They witnessed good recovery in CV space. PV is witnessing a strong continued growth. CV profitability also improved because of good mix of MNHCVs and ICVs and ongoing cost savings, of course, which are the key drivers. The company is working to debottleneck supply chain. They're ramping up output to address the supply constraints. And despite the global challenge of semiconductor supplies, they remain confident of keeping performance improvement on track. They're confident of achieving targeted savings of 6,000 crores and expect to finish strong this fiscal as well. So overall, the commentary has been very encouraging, and they've given good visibility for at least the next one quarter, that's Q4 of FY21, and they expect to conclude this year, this particular fiscal as well, on a strong note.